Morning, participants. This is Ashish Powle from Bank of Baroda. I look after the credit risk for the bank for retail, rural agri, and MSME portfolio of the bank. Welcome to this hackathon. It's great to have you as participants for this initiative by the bank. As I'm sure you're aware that Bank of Baroda is one of the large public sector bank with a significant digital footprint, which is growing day by day. I'm so sure that you are subscribed to our YouTube channel where we post our digital evolution at a periodical interval, where you can see which are the areas where bank is growing in terms of the digital footprint. Uh, in this series, I'm sure you would have gone through the earlier sessions by our learned colleagues, senior colleagues from the bank, who have spoken about various products which banks deals in, and how do we actually deploy the account aggregator framework in the various use cases which the bank is in. Uh, Today, we are going to talk about the typical risks which the bank deals in or faces during its business uh, under different products. Uh, I'm sure you would have gone through the account aggregator infrastructure or the master directions by RBI. It is one of the active uh, regulation by RBI, which is updated proactively almost every year by RBI, keeping in pace with the digital evolution which is happening. Heartening to see that this is well ring fenced architecture, which eases out a lot of uh, risk concerns which existed in the existing framework of dealing with banking products. Uh, Today, we will not get into the regulatory framework or the technical framework of the account aggregator set up by RBI, because when I would invite you to go through the earlier sessions by some of my senior colleagues who have dealt with it in extremely detailed and elaborate manner, which will give you an detailed understanding about this piece. Today, we'll touch upon the risks, how they existed in the current framework of banking products, especially focusing on the lending side of business, our business, and how they're getting addressed by the account aggregator framework. Moving on, banks typically deal with these four lines of businesses: liability products, typically deposits, investments, etc. Lending products, typically loans, cards, lines of credit. Investment products, which comprise of mutual fund, wealth, and fee-based products like lockers, guarantees, advisory services, third-party products, sale of third-party products. So these are four broad lines of businesses. Uh, the BFSI industry as a whole today has created a great use case for account aggregator in around lending products. And however, the framework has a great potential for deployment under the other areas of the banking products as well, especially liability and fee-based products. Uh, so that's about the overall the gamut of deployment where account aggregator framework can be applied. Quickly moving on to some areas of risks which banking entity faces. Uh, the boxes which are highlighted in yellow actually indicate the areas which are positively impacted by the account aggregator framework, while other areas like reputation risk, legal risk, etc., do have positive implications once we have a deployment of AA framework in our bank. We'll dwell upon each one of them as we go along our session. As I said, we will not really get into the regulatory framework of the AA because it has been dealt with at length in the previous sessions. It will be repetition if I touch upon that once again. However, it is pertinent to mention the kind of financial information which the account aggregator framework uh, aspires to provide. The list on the left hand side on your screen actually talks about various financial information which is proposed to be brought under AA framework. As of now, as I understand, banking products, uh, there are participants, there are FIPs, I think 19 or 21 FIPs which have already onboarded on this setup. HDFC Securities, as I understand, is the only participant on insurance policy side, and GST is soon to start. That's what I understand from my network of colleagues. Uh, as soon as we have the other FIPs for other products get onboarded on the account aggregator framework, this framework is going to be enriching for the entire BFSI industry in terms of the use cases. We shall await those developments as we go along this journey. On the right hand side, you will see the kind of customer constitutions which the AA tries to address. Unlike our conventional method of working in banking, getting information from non-individual entities has been a cumbersome job because and especially in a digital mode where largely the physical mode of documentation was resorted to. The digital evolution, which has largely happened, which has happened on the individual side, the non-individual entities due to multiple signatories, authorizations, etc., etc. There were issues around getting relevant information about these entities in a digital format. The AA will solve this problem to a great extent based on the consent, either one time or period based consent from these entities. The information could flow to the banking or financial institutions, which can be deployed under various use cases. So these are two key highlights I thought we should mention because this augments the whole scope of various products which we could provide to these entities by this enriched information. Now, quickly moving on to a typical life cycle of lending product. So there are various stages and steps which we see a typical lending product will go through. There are two broad steps. One is pre-onboarding, and the second one is onboarding and life cycle management. Um, the first step is identifying the prospects in terms of the target market, the target customer segments, the bank's aspiration to penetrate into specific uh, uh, areas or the product segments where the bank wishes to grow. So that's the stage where the market identification happens. Based on the market identification, the campaigns are carved out. uh, Once the campaigns are carved out, there are cold or hot leads. Then once the leads are catered through either by digital or non-digital modes, there is an application stage where customer actually applies for that product. Post application, there is a documentation stage, which is pre-approval documentation stage. Typically, a pre-approval documentation stage would exist in a lending product. Liabilities may or may not have the pre-approval stage. The reason I have chosen the lending life cycle because it has a granular and a longish uh, life cycle as compared to liability products or investment products where the steps where account aggregator framework can be deployed are pretty lesser as compared to lending product. Moving on with the flow, once the pre-approval documentation is done, there is a stage of verification of customers. these verifications could be either in terms of verification of their employment, the documentation which they submitted, their income, their financial standing, their repayment track record, so on and so forth. Then there is a stage of, based on these inputs, there is a information provided by the customer and the verification result. There is a stage of evaluation. Once the evaluation is carried out, there is ultimately a decision which is taken whether to grant the line of credit or not. So these are the typical stages where the pre-onboarding, pre-customer acquisition stages take place. Post-onboarding, obviously there is a post-sanction documentation like agreements, various undertakings, and so on and so forth. Post that, there are verifications around the security in case it is involved in the lending transaction, the valuation of securities, the legal stature of the security. Once everything is found in order, there is a stage of security creation where banks charge on the securities created. Post that, it moves to account opening where actual disbursement of the product happens, where money is released to the customer or to the end use which the customer is willing to go for. This is the stage where customer is fully acquired by the bank. Thereafter, the stages of account servicing would start. Account servicing would typically involve day-to-day management of the account. It would involve um, statement request. It will require prepayment request. It will require change of repayment modes, and so on and so forth. Then there is a stage of recovery, which could be normal recovery when the customer pays regularly, or it could be recovery through manual interventions where there are defaults, and so on and so forth. And ultimately, the account goes for closure. Uh, when the account is onboarded, there are two important steps where the customer is offered products through cross-selling and upselling. So when a customer is found to be beneficial to the bank, is performing well with the bank would obviously want the higher share of the wallet share of the customer, and that's where uh, the additional products or the desired products by the customer will be offered to him or her, and that's how we increase the stickiness of the customer with the bank. Now, having seen this entire life cycle, let me touch upon where exactly today manual interventions happen, which could be taken away by the account aggregator framework. In terms of campaigns and leads, where you're selling additional products to the existing customers of the bank, you would be greatly, I mean, the bank will be greatly benefited by the account aggregator information which is flowing to the bank in terms of the income source of the bank of the customer, the products he's looking for, and so on and so forth. So it's a great enabler when we are going to identify the pre-approved base for the bank, where today the conventional tool actually relies only on the repayment track record with the bank or off bank through bureau records. The typical financiers today are have a blind spot in terms of how are his cash flows, what are his spending patterns. Typically, the profiling of the customer happens around the borrowing and the repayment thereof. The AA framework is going to really add a great dimension to the ability of bank to pitch in the relevant products to the prospective customers, which are either internal or new to the customer, new to bank. The application stage is largely digitized for individuals, which would continue to be so. At pre-approval docs, this is the stage where we would see a great value add by account aggregator framework. Today, the bank statements, which is a critical document for any assessment of a lending product, is sought either in the physical paper form, or I mean, there are entities where they have enabled seeking these bank statements in a ePDF or PDF form, which could be read by machines. As you would understand, and it has been well elaborated in the previous sessions by our earlier speakers, that consuming the physical bank statements or the paper-based bank statements into assessment of customer in terms of um, risk profiling is quite difficult because of analyzing that information. The conventional mode today actually uh, envisages that some individual would actually input the bank balances or critical entries in the bank into some system which actually analyzes the bank statement, and then thereafter some decision about the quality of banking of the customer is taken up. Here, the account aggregator framework will actually help the banks to consume the information of the banking of the customer directly into their algorithms. So today, those large organizations which are assessing customers based on scorecards are using the demographic parameters and the bureau parameters for assessing them. This will add a dimension to the customer's verification or the financial standing. We will talk about this in the subsequent slide, where we'll dwell deep into risk profiling of the customers. Moving on to verifications part, as I mentioned earlier, the bank statement today has to verified for the authenticity of it. Two reasons: one, the physical bank statement, the photocopies, etc., uh, are uh, uh, are prone to tampering. Similarly, even the PDFs. I mean, uh, there are softwares in the market which can help the fraudsters actually tamper with the entries in the bank statement. The recipient bank today does not have a structured way of verifying these bank statements which are provided by the customer. This is the area where the banks can be rest assured that the information is flowing directly from the core system of the bank which is providing this information, or the entity which is providing this information. And there is no way that this information could be tampered with. It brings down the possibility of fraud to a large to I mean to almost nil extent. Uh, Going forward, then the information regarding customer which is flowing through either banking or through other products which we just saw on the previous slide, once it start flowing in, will help organization evaluate the customer better in terms of his credit standing, as against the conventional tools today which are just focused on the salary slip or say income tax return, etc., etc. Moving on to post-sanction documentation, verifications, etc. Here, just before the onboarding of the customer, especially in a pre-approved database, the banking entity could just recheck the account aggregated information, and just in terms of the sustenance of what were the assumptions at the time of giving the offer to the customers in the pre-onboarding stage. Generally, the pre-approved offers are valid for 30 to 90 days period, depending on the type of product. There is that blind period of 30 to 90 days when banks really don't know what transpired between this period, and there are slippages in that period. The framework, account aggregated framework, actually eliminates that fear as well, uh, with the help of fetching the banking information in the interim period, especially knowing whether the customer has gone for any additional borrowing. The disbursement of that additional borrowing is figuring in that bank statement. Uh, so those areas brought down. Those areas of concern are actually brought down. Uh, Regarding now account servicing and recovery piece, where banks have access to the bank statement information of the customer. As I mentioned earlier, it helps pitching in the right cross-sell or upsell products to the customer depending on the need, what he is looking for. And strategizing recovery based on the account information of the customer would also help. We look at it in the subsequent slide. So just to summarize the previous slide, as I mentioned, there are these broad steps, broad stages which the customer goes through. The pre-onboarding stage, as we mentioned, prospecting is where, for at least for ETB customers, account aggregator framework will really help. Onboarding, as I mentioned, during the onboarding stage, lots of verifications, customer profiling, risk profiling, etc., is well addressed by this framework. Monitoring is where we'll talk more on this slide, where the accounts which are typically of revolving nature, working capital limits or packing credits or even credit cards for that matter, which require a constant monitoring of utilization by the customer and servicing of the account. The line management here, the amount of loan or the credit line which the bank offer has to be far more dynamic, and it has to be far more monitored to maintain the quality of the asset book. Based on this monitoring, the bank then decides whether to augment or enhance the wallet share, offer more products to the customer, gain more share of his financial health, uh, or looking at the transactions or looking at the way the customer is behaving with us, just maintain where we have our stake as of now, or reduce it gradually and then possibly exit the account given the concerns in the dealing. Today, the whole monitoring is largely dependent on customer cooperation. In retail, it is actually very difficult to get incremental information post onboarding from the customer, because customer really do not want to be bothered once they are onboarded, as long as they are paying well. This is where a backend monitoring by bank would help them without bothering the customer to go through either of these stages. So this is one great value addition. As I mentioned, account aggregator framework is actually all positive impact on the risk management of the bank. Not only in terms of credit risk. There was a session a few days back which was taken by our cybersecurity team, where how this framework addresses those issues also has been dealt with. I would urge you to go through that as well. Moving on to the next part, where I was talking about what are the different areas of credit risk management where account aggregator framework would have great use cases and could bring in a lot of impact efficiency in the banking operations. The first stack here you would see is customer risk profiling. The boxes which are in yellow, as I mentioned, are areas which are either directly or indirectly positively impacted by account aggregator framework. Identity verification, as we discussed, since the information is directly flowing from the core system of the FIPs, and it is based on the customer consent, which is duly validated through KYC and other modes, and through multiple factor authentication. The identity obviously gets established apart from the current modes of eKYC, etc. The second part is the repayment capacity assessment based on the transaction in the bank statements and the balances maintained, not only in one bank statement. If the customer gives consent for multiple bank statement, an aggregated view about the balances or the wealth the customer maintains in different forms will give a great boost in terms of the capacity of the bank or capability of the bank to assess the repayment capacity. Cash flow assessment, it is an obvious use case where banks could now analyze pretty well in terms of the inflows and outflows, and the type of outflows, especially whether those outflows are expenditure driven, whether those outflows are savings based. It gives a different dimension for assessing the customer's acumen towards the financial health, his own financial health. Repayment track record today is largely addressed by the bureau report. Uh, our bureau reports are not real time. They are based on at a lag based on the reporting by various financial institutions. Here, through bank statement, we could see the repayment right till the last EMI which has gone without much of lag. This is one great value add by account aggregated framework. Contactability, obviously, the customer sharing the demographic information through this framework will help us validate the information which is provided through the application for the product, and cross-check that with the information which is flowing from the other bank where he's actively maintaining his banking. It helps us strengthen the contactability part of with the customer. Eligibility assessment, this is one area where again today's conventional modes rely largely on the proofs of income provided by the customer in physical form like salary statement or ITR. The banking or the other products information, the investment products, etc., as and when they start flowing in, the banks will be more equipped to do far more realistic assessment of eligibility of the customer, loan eligibility of the customer, looking at various factors, as I mentioned, the cash flow, the repayment track, repayment capacity, the occupation, etc., which will help customers also optimize their loan requirements. Occupation could be indirectly verified through the regular income sources which the customer has. And pricing is one area where, based on now the robust customer risk profiling through these modes, banks will be able to take far more risk-based pricing call on the customer, which will be a win-win situation for both banks and customers as well. The stack below talks about the operational of fraud risk. This is one area where the banks have some tools which are largely physical in nature. Uh, this is where a great deal of value add is being done by account aggregator. Impersonation risk, which existed, or set of frauds which existed today, will get eliminated by account aggregator. Document forgery, as I mentioned in my earlier slide, is big concern, especially in large volume products, small ticket products, where the TAT is critical, and the financial institutions are not at a great liberty to spend a lot of time in terms of verification of the documents which the customer has provided, because there is a competitive environment. This is where the entire verification of information is automated through this framework. IT and digital frauds which are perpetrated, set up, can be eliminated. Misrepresentation of information now will be again eliminated by validation of information through the sources which are coming right from the core. The other benefit is TAT, as I mentioned, based on the automated verification and the algorithms, internal algorithms. Now the decision by the banks will be way too faster. Data leakage, which is today the physical documents are maintained by banks. They change hands through different desks, different departments, uh, uh, which could lead to data leakage of the customer, is largely eliminated now. And process failures, which had manual elements till now, and there could not be really a maker checker which could be established due to straight through requirements of the competitive environment, uh, will now be eliminated. Uh, this is the last slide I would want to dwell upon. As we discussed, it's all about positives about the account aggregator framework. There are a few challenges though which get discussed in the fraternity. The bigger challenge today, which we see, is the participation and onboarding of the financial information providers. The circular, the framework was released by RBI somewhere in 2016, and it continued to get evolved even till date. Given the number of players today we have in banking and financial ecosystem, the participation today is fairly minuscule. So this is one area where there has to be, a lot of banks and a lot of financial information providers will have to start getting onboarded onto account aggregated framework to make it far more richer. The challenge of this not being there, not all participant being there on the platform, is on the technology teams, where they might have to build hybrid workflows where customer has banking or the other relationships we discussed with those FIPs, where they are not part of the account aggregator framework, where the flows will have to be defined in a hybrid manner, where it goes to the manual mode, it comes back to the normal straight through mode, and so on and so forth. It complicates the whole workflow. That is one fallout of this issue. The second part, which is critical, as we've seen, the frauds on the digital side are on rise, and I mean, one of the key reasons for that, the customers aren't aware about what needs to be shared, with whom needs to be shared, the two-factor, three-factor authentication, the sensitivity of OTPs, and so on and so forth. The A framework today talks about two types of consents. One is one-time consent for a transaction, and the second is a period-based consent, either 6 months, 1 year, and so on and so forth. So the customer awareness around this piece is going to be extremely critical, and the financial institutions will have to play a big role when they are making customer use the AA framework for availing the products and services. So that awareness is extremely essential, because the information now which is flowing in digital format, if the customer is not aware what purpose it is being used for, and whether he's okay for that information to flow either in one time or in continuous mode to the entity which is seeking this information, in terms of his privacy concerns, and so on and so forth. So this is one area where when we are building our platforms, the customer awareness is going to be extremely critical. The customer awareness around revoking this consent should also be one of the important areas, where customer has to be made aware that he has a right by regulation to withdraw the consent, where the information sharing could be stopped immediately. Um, uh, uh, the areas of frauds here could multiply if there is a misuse of information. The last point, which is about that non one time consent, where customer does not withdraw a period based consent, and the entity which is seeking this information continues to virtually draw this information every day, or at a very very frequent interval, and it actually um, slows down, and it is an excessive use beyond the use case for which the information has been shared. So these are the three concerns which the fraternity today is talking about. If this is taken care of, this is one great tool for the banks and the financial institutions and other BFSI participants to manage the risk pretty well um, uh, for for their banking products. So that's it from me today. Thank you for your patient listening.